The broadcast is now starting. All attendees are in listen-only mode.
Okay, so it's been quite a week for markets and interest rates. I don't know if you want to launch us, Mike?
Yep, Chuck, so we'll go ahead and get started. Let me just do some introductions, and then Chuck will do it as a back and forth between the two of us, so I can sort of walk you through how we get there. Everybody, thanks for being on our webinar. 20 minutes. We're going to try and keep this fast-paced. If you have any questions, feel free to type them into the chat box, and we will go ahead and try to answer them in real time. Again, we appreciate everyone's time, so we are going to keep this to 20 minutes. Interest rates, market volatility, both speculation on both as to how they are moving, where they are moving, and why they are moving. So we're going to go ahead and get started with today's agenda. Why the Fed is behind the curve, our expectations for 2022, what is going on with technology, and then, of course, the long-dated bond market, which has taken a beating. How advisors can be thinking about things, should be thinking about things, so on and so forth. So, Chuck, first and foremost, you can see here, this is GDP, and it's part of how we got into the mess that we're currently in right now with regards to COVID. U.S. printed a lot of money even after recovery. Thoughts on stimulus? Do we need more stimulus, or are we up and running? Is this story on its way?
The last thing we need is more stimulus. As you can see from this curve, GDP is back on the track that it was on before the pandemic. So the Fed did an awful lot, the government did a lot, and basically they did their job. The recovery was very strong, very swift, exceptionally so historically. We're back.
All right. It's always good news, V-shaped recovery. Here's something to put in context. I wanted to show you here the slides. Right, the CARES Act, $2 trillion. There was the $900 billion stimulus. Then there was the American Rescue Plan for another $1.9 trillion. To put in context the amount of money the government spent in order to get us out of COVID, right, compare this to the 2008 bailout, which was systemic. That cost $700 billion. TARP was $700 billion. So we are in the multiple trillions here, and it worked, right? This is what it looks like, though. Money supply, Chuck, you can see COVID there on the right. Clearly, we had a money supply problem beforehand, but on the right-hand corner, this is blown out. All causing some of the problems we have with inflation. Agreed?
Yeah, the Fed has, continued to buy bonds and dump reserves into the system long after the economy was rebounding very strongly. The Fed is only now beginning to taper the bond buying program. A month ago, they tapered by $15 billion, and then they woke up and realized just how strong the economy is. So they doubled it to $30 billion per month. But they're still buying bonds, and they're going to continue to be buying bonds until March if they stay on the current plan. It's possible they'll even accelerate the slowdown in bond buying. But right now, you can see that there's a tremendous amount of liquidity that's been added to the system, and that's precisely why interest rates got so historically low.
All right, but this is what the Fed did, right? And you can see here, in order to stabilize the economy. So perhaps jumping ahead, but I'll go ahead and do it. Why, knowing that interest rates are going up, knowing they have a problem here, they're behind the curve, so on and so forth. Why are they still buying bonds? Why is that still going on in any capacity whatsoever right now?
Yeah, that's a great question. And a lot of people have told them they're behind the curve. There may be a political element here. Powell wanted to get reappointed, obviously. He knew the progressives were gunning for his tail, so he didn't want to offend them. And therefore, he kept on emphasizing the need to get back to full employment, defined as the level of employment before the pandemic hit. But in the meantime, the labor market's changed. There are people who've retired, a lot of people. The baby boomers were retiring at the rate of about 10,000 people per day. But that accelerated after the pandemic. A lot of people decided to just hang it up. And then others, of course, have difficulty going back to work for a variety of reasons. They may have comorbidities. They're afraid to go back to work. They may have kids who are at home. So there are a bunch of reasons why they might be slow to go back. But the bottom line is the labor market's already tight. Everyone has told the Fed that's the case. The Fed kept on pushing to try to promote a stronger growth, and we're paying the price in the form of higher inflation.
So that's exactly right. That's the next slide here, right? It worked. The economy was stabilizing. My guess is very quickly, in asking you, Chuck, the Fed and government did what they had to do at the time, and at the time, those decisions seemed right given the information they had at hand. Correct?
I agree with that.
Yep.
I think the Fed did the right thing.
And now we're paying. Now we have to pay for it, though, right? No such thing as a free lunch.
But they also kept at it for too long. That's where I would fault them. I would not fault them for throwing the kitchen sink at the economy to make sure that there was a recovery underway. I think that makes sense. But they kept at it long after the economy was clearly on a recovery trajectory.
So as a result, here you are, right? Everybody knows inflation is up. This is less food and energy. If you factor them back in, that number is over 7. It needs to be addressed, right? This is problematic for the economy. So, Chuck, this is the March 16th meeting. Clearly, the expectation here is that interest rates will be going up. You agree with this? And is 25 basis points the right hike?
I think it is extremely likely that we get 25 basis points at the March meeting. There are several senior Fed officials who've come out publicly and indicated that they favor that. And this Fed style has been to be basically tell us in advance what they're going to do. And so I take those public comments as indicative. It's not just, thinking about it. They're telling us. And so the market is on board, realizes it. And so we're pretty much priced for 25 basis points in March.
All right, so let's stretch this out a little bit because clearly we're talking about a year-long issue with rates. The expectation here is for 2022, this is December probabilities, rates are going much higher. There is certainly, the thought that you can see there, 150 to 175 is not off the table there on the right side. Anticipation, thoughts on how many times the Fed could raise rates this year and where we end the year?
Yeah, so the Fed has pretty much told us that they are going to raise probably 4 times this year. There are a couple of individuals who are not fully on board with that, but Chris Waller, who's on the board, suggested he might be open to 5, but it's also premature to make firm conclusions. I think 4 is I would almost call that a safe bet. It's overwhelmingly the highest probability, and that's correctly figured out by the market. But a lot of what happens will, of course, depend on the data. And if the inflation data does not recede, and the Fed is kind of counting on the inflation data receding. But if it doesn't recede very much, then this much tightening is sort of in the bag and potentially more, and certainly more for next year.
So how can, and I know a lot of advisors ask this question, a lot of investors ask this question, how can you trust, or how can we say we need to watch the data, right? And the people who are watching the data are the same people who said inflation was transitory, or, they didn't need to raise rates yet. Sometimes the data is wrong, clearly, or they misread it, or however you want to interpret that. But, I guess how can we watch the data as being the right outcome? Because obviously, for all the advisors on this call, it's part of how they position portfolios.
Yeah, so there are 2 points to make. One is forecasting is very difficult, especially when you try to forecast the future. And the Fed got the forecast wrong, just flat out wrong. Inflation has come in much hotter than they expected. The unemployment rate has fallen much faster than expected. And so the Fed's policy stance was not calibrated for what actually occurred. The second piece is the Fed has been slow to respond. Initially, they told us, and we knew this, that the Fed wanted to see the whites of the eyes of inflation before they responded. They didn't want to anticipate. But by doing that, they're responding late. And everyone sees that. And there are a lot of outside critics who pointed this out to them. And the message is finally sinking in.
Yeah, I remember a year ago when the goal was to get inflation at 2%, and they were concerned that would be a struggle. Right? My how things have changed. Right. Forecasts, right? This is important. So this is where things are being forecasted going out a couple of years. So for advisors who are thinking about how it is they want to position portfolios, fixed income, that type of thing, here are forecasts going out to 2024. You can see GDP coming back in line here with historical averages as the Fed funds rate goes up, inflation is up, and unemployment is down. So by 2024, we're expecting an unemployment rate of 2%. Thoughts on this, Chuck?
No effing way.
Okay.
We've never seen an unemployment rate of 2%. And yet that is what comes out when you use the GDP numbers that the Fed itself has forecast. So 21's in the bag. It's about 5.5%, unambiguously strong. And you can see the impact of that on the unemployment rate. The Fed was forecasting that the unemployment rate was going to drop to 4.3. The actual unemployment rate, 3.9. So the labor market has tightened much, much faster than the Fed expected. And at 3.9, we're now only 0.4% away from the estimate at the end of 2022. So the labor market is critically tight and getting tighter. And it is almost inconceivable. I think of this forecast as more of wishful thinking than I think of it as an actual forecast.
All right.
Because I don't.
But that, yeah. All right. So then let's focus on these numbers, though. So a lot of people are saying this is rampant speculation out there that the Fed cannot raise 3 or 4 times, or cannot raise 5 times, or cannot raise next year or 2023 when you're doing so into a period of declining GDP, of slowing growth, right? Can you raise rates into a period of slowing growth and not cause a recession?
Well, the fact of the matter is these GDP numbers, which are slowing, are actually still too strong. The underlying growth potential of the economy is about 1.75%. So as long as the economy grows faster than 1.75%, the unemployment rate will fall. Now, the Fed is persistently forecasting a gradual tightening of monetary policy. And I think this is as much psychological manipulation as it is a real forecast of Fed policy. The Fed does not want to scare the market. And what Michael just said about people worried that growth is slowing and the Fed is raising rates and it's going to tip us in the recession, that's one of the reasons why the Fed is saying some of the stuff that it's saying. But in point of fact, even with these interest rate forecasts, they're too low. Go out to 2024, and the Fed has a forecast of 2.1% on the Fed funds rate. The rate of inflation today, is anywhere from 5 to 7%. And now the Fed is forecasting a slowdown, but that doesn't even make sense. Go to the next slide, Mike. And there you go. So there's the rest of the forecast. If the unemployment rate continues to fall, it's hard to see why inflation is going to moderate as much as they hope. Now, there are some things in inflation that will unquestionably moderate. A perfect example, everyone's talked about it, is auto prices. So used car prices are up sharply, new car prices are up sharply. The auto companies are having trouble producing vehicles, although production is slowly rising. And so the supply will improve. And as it does, that will cause car prices to go back down some. But they've got to refill the pipeline. We're at least 1 million or more vehicles short of what we need. So there's a lot of room for increased production. But the biggest problem is not a specific narrow area like cars. The biggest problem by far is the labor market. labor is used to produce everything, goods and services. It's overwhelming, the overwhelming fraction of total cost of producing services, but it's the overwhelming fraction of producing goods as well. And so with a tight labor market, wage rates, which have been accelerating, are likely to continue to do so. And that's pervasive in the economy. So there'll be some benefits, lower prices for some commodities as supply chains improve, lower prices for cars, lower prices for other things, but labor costs are going to create an upswell across the entire economy. And so the inflation numbers are not likely to prove anywhere near what the Fed is hoping for.
What about lower prices for tech stocks, right? There are a lot of advisors on this call because, they're interested in our thoughts on what's going on in the tech market, right? Obviously, future growth for, you can see there on the screen, unprofitable tech companies just becomes worth less. Future cash flows become worth less as interest rates are higher. Are you surprised by the tech sell-off? I thought this was interesting. The non-profitable technology index you can see has been pounded. This is, Lyft, Carvana, Roku, some of the components in here. Are you surprised by what's gone on in tech?
No, theoretically, this is exactly what you'd expect. So longer maturity assets are hurt more by rising interest rates. And when you're talking about non-profitable technology companies, they are clearly very, very long maturity assets. They're hoping for profits 2, 3, 5, 10 years down the road. And when interest rates go up, those future profits get discounted by larger fractions in the denominator. So the market valuation for these kind of companies goes down pretty sharply. In contrast, there are a lot of value stocks, banks and insurance companies. They actually benefit from rising interest rates. And we have a number of the banks that reported earnings earlier today, and they're talking about improvements in their net interest margin. So it really is pretty basic math.
Before
when
we
interest rates go up, bonds and long-dated technology stocks become worth less.
Before we move on to the next part about bonds, the question everybody wants to know, and I'll throw it at you, and you could say, I don't have the answer for that. That's okay. How do you know when the sell-off is over? How do you know when advisors should be comfortable putting money back to work? Or is this one of those things that you'll know in hindsight and so on and so forth? Could the move down in a bunch of these names continue, I guess is what I'm asking.
Yeah, the answer is yes, it can, and it probably should continue. Because with some stocks, you're really guessing, and the market is guessing about when they're going to become profitable and how profitable they'll become. So there's a very large range of error. But with a lot of technology, profitable technology companies, they are still rapidly growing, but we have earnings for them both today and pretty good estimate for next year and a decent estimate for the year after that. So you can put these things through dividend discount models and you can do the calculation. But the critical variable in the calculation that you also have to include is where are interest rates going? Because if you look at the bond market today, it is not priced for a dramatic rise in interest rates. It's priced for far less tightening of monetary policy, for example, than the Fed has forecast. And so that's where the risk is. And there's a lot, if there's a lot of upside risk to interest rates, by definition, there has to also be a lot of downside risk to technology stocks and non-profitable companies.
All right, let's take a look at bonds, right? We're going to start to wrap this webinar up fairly quickly. But bonds, right? Interest rates mean new bonds get issued with higher coupons. So for advisors who are buying bonds for their clients, you can see on the screen there, this is what you need to know, right? If a corporate bond has a 3% coupon and it is trading at 100, a 10% maturity, a 10-year maturity, the Fed issues the government issues a new treasury with a 4% coupon. Everything else is exactly the same. What would you rather own? Right, the answer is the 4% coupon, obviously. It's backed by the full faith and credit of the government, and it pays you a higher coupon. So in order to have an equal credit spread with 100 basis points, the difference between the 3% coupon and the 4% coupon, your corporate bond is going to move from 100 to 84.40. That is the loss that you will take on your corporate bonds, right, in exchange when compared to a new asset that's out there. That is the correlation of fixed income and interest rates, right, and or the impact of fixed income and interest rates. So everyone can see that on the screen there. Very, very important. If you have client portfolios with individual bonds, bond mutual funds, check your durations. How is it? It's very important now, more so than it has been in the last 30 years, to understand what it is that you own. So let's look at some of the damage very quickly. 10-year bond sell-off, right? You can see there the first week of the year, negative 4.24, worse than 42 years. That has been pummeled, and rates didn't move that much, right? They went from 1.4 to 1.8 on a percentage. It's a big move, but you're still at 1.8. 30-year, the long bond, crushed, right? Worst total return going back in forever would be the 9.35, right? This would be the 5th worst year ever if the year stopped here, and this was only week 1, right? So the long bond has gotten crushed, right? So again, understand what it is that you own. Again, want to end on a little bit of comedy here. You can see interest rates tied to the height of the federal chairman of the Federal Reserve. If you have not seen this cartoon here, you can see Volcker, Greenspan, Ben Bernanke, Janet Yellen. Rates went down as they got smaller in height. Here comes Powell. He's taller, and rates are going up. All right. To end on a positive note, Chuck, thoughts? Interest rates have gone up before. This is not something we've never done before. The S&P has given positive returns during those time periods. Chuck, thoughts on putting money to work quickly? You got 30 seconds.
Yeah, so in the case of the bond market, stay very short, very simple, and floating rate instruments. In the case of the stock market, as you can see, even when rates rise, rates are rising because the economy is strong. And because the economy is strong, corporate profits are actually going to do quite well. So if a company has profits and it's growing very nicely, chances are good it will hold up a lot better than somebody that doesn't. And as you can see historically, just because the Fed has raised interest rates does not mean that the stock market's got to go down. We're still comfortable with market valuations, and it's just be in the right places. That means the reopening play, value plays, especially companies that benefit from higher inflation and higher interest rates. So the banks, real estate investment trusts, insurance, even airlines and hotels, those will all benefit in the coming year.
I like to think also, that there will be another crisis. There will be another recession, and the Fed should have rates to cut, right? That is a very important tool to have, right? Obviously, nobody wants to go into negative interest rates, so you should raise them when things are good.
Yeah, well, keep in mind that you still have negative real interest rates. So even with the small backup that we've seen in interest rates so far, real interest rates are very, very negative. Tips yield minus 1%. So the Fed is still stimulating the economy. And there's very little reason to have fear that the economy is going to lapse in the recession anytime in the visible horizon.
Let me do a quick promo on ACM, the use of individual securities, right? Clients own cost basis, no mutual funds, tax efficient workouts for low cost basis issues, client instructed restrictions. We can help you win prospects with statement reviews. Stay in touch with us here. On the left side, if you take a picture of the QR code, you will get to our LinkedIn page. On the right side, if you take a picture of the QR code, you will get to our Twitter page. That is my email address on top. Email me about anything and everything. If you want to send over some statements for statement reviews, feel free to email them. Here is our information. Looks like we are good on questions. So thank you all for participating in today's 20-minute webinar. We came in at 25 minutes. I apologize. I hope we didn't ruin breakfast on the West Coast, lunch on the East Coast. If you like what you see, shoot me an email. We'll do these more often. Again, thank you everyone for being on today's webinar. Talk to you all soon. Thanks, everybody.